All right. Well, welcome to Property and Paper Live. This is Dawn Rickabaugh of NoteQueen.com. I'm so happy to have you here. This is where we talk about owner financing, notes, real estate investing. Well, basically, real estate investing you have over here, note investing you have over here. And the thing that connects them is seller financing. Of course, we have institutional paper, but the traditional note business was always owner carry paper in its original form. So anyhow, I have here tonight Abby Shemesh of Amerinote Exchange, and it's such a pleasure to have him on. We used to do this fairly often back in the day, and it's been a minute. So it's always so fun. I know our last, was that 2020, our last call that we did together?
I know, I remember the exact date, as a matter of fact, because it was the day after they locked down for COVID. So it was like the 19th of March.
Oh.
Seriously, you're like the 20th. It was like 19th or 20th of March.
Yeah.
Yeah.
Funny thing is, I just went to my first like real estate type meeting, going somewhere last night, and now we're just back on. So I guess it's fair game. I guess my PTSD from COVID years must be wearing off. But, anyway,
it coincides with presidential cycles. The PTSD, that is. No, it's been a minute. It's been a minute.
Yeah. Okay. So just like we normally do, today we're probably going to be focused mostly on notes. The note investing side, note brokering, and maybe the market in general, whatever comes up. But of course, go ahead and chat your questions or raise your hand if you've got something. And Abby, you can help me keep track of the chat.
Sure.
Sometimes there's a lot of things, a lot of little
I gotcha.
people and things like that. So
yes, ma'am.
Anyway, catch me up. How's business? It's been a lot of changes, right? We've had a lot of changes.
A lot of changes. There's a lot to unpack. That's a very dense question. The short answer is it's been feast or famine is the way I can describe it. But that's a big one to unpack, because whether you're, in the seller finance space, buying properties and manufacturing mortgage notes, right? Manufacturing seller finance notes that you plan on holding, you're not going to really see it's nice and even keeled, and you're not really going to see the conniption fits that are happening in the market. But when you start bringing these assets to market, right? So you start shopping them around, you start selling these assets, you're going to find very quickly as you progress through the industry that whether you're in the primary mortgage market, which is the lending of real estate through institutional capital, like institutional players, banks, and so forth, as well as the secondary mortgage market, which is the trading of mortgages, whether it be through institutions or privates like us, we are all at the mercy of the capital market environment, meaning the Federal Reserve and where those interest rates are. We're at the mercy of them. If we're buying real estate, we're at the mercy of them for buying notes. We're at the mercy of them for buying eggs. We're at the mercy of them for buying gas. So we're at the mercy of these maneuvers that are being played out before us. So that interest rate hike and the quantitative tightening that's been going on, I think since 4 or 5 days after the Ukraine invasion, that's when the official, the Fed and all the central banks, the Bank of International Settlements, everyone decided to start pulling back the liquidity, and it's been crazy up until August of 23, and then it just went sideways. And there's a lot of reasons for that, but business has been sporadic. It comes in torrential downpours and then droughts, and that's really what we've been seeing, specifically in the second and third quarter of this year. So we're in the middle of a torrential downpour right now.
Are you?
Yeah, so I got my galoshes and my Gilligan's Island, uniform on when they're getting splashed around on the water, the skipper suit.
I guess since I do a little bit of everything, it's I've always got something going on, but
Yeah.
so there's always some little dribble of things going on, whether I'm closing on a property the end of this month, and then there's always little note things that I'm bidding on here and there.
With
But
us as well. You have a couple with us, as a matter of
yeah,
fact. Yeah.
yes, a couple we're seeing, but it seems I think it'd be interesting, and since the volume of the things that you see,
Yes.
maybe you could just give people let's say how was it the institutional, let's say the institutional appetite for,
Sure.
or even the big hedge funds or the large families that buy these things up last year to now. I
Mhm.
mean, there was a time where sort of everything turned on a dime. It seemed like nobody was getting return phone calls and things like that, as I guess the underwriting was changing. So
Yes.
uh,
Drastically.
yeah, would you mind just commenting on the
Sh-
general
Sure.
appetite and things that you're seeing?
Well, with regards to, I want to just preface this by saying, there's two separate types of interactions that we'll have in the mortgage loan space and the loan acquisition space, and that's with private lenders, private note sellers, right? That's a much different conversation that you're going to have than, say, with a chief financial officer, or chief credit officer at a bank. I will tell you that the banks are not budging on like everyone's like, oh, residential, non-performing. I got my money sitting on the sidelines, rating. Everything's going to come down. The interest rates are going up, foreclosures. None of that's happening, and not even in the commercial. Everyone thinks that the commercial is going to fly off a cliff because of COVID, right? So you have empty apartments, or excuse me, empty office buildings.
Right.
The living assist facility market crashed as far as the real estate appetite there. Everyone wanted that during COVID. Now everyone's trying to sell it as quickly as they got in. And,
Yeah.
and even with the commercial product, we are not seeing banks. Everyone's a wait and see. So we've transacted, and the majority of the stuff that we transacted on are home equity lines of credits, home equity lines of credits that are out of the draw period. So the draw has closed. Now it's the payback period, right? So they spent their home equity line over the 36 months or whatever the draw period was, and now they have 20 years to pay back. That's the most appetizing type of second home equity that we want. So we're seeing a ton of that trade. We're seeing a ton of first. I really wasn't even aware of this up until recently, like the past 2 years, but first position HELOCs, home equity lines of credit, are big as well. And then ITIN loans. I don't know if you guys are familiar with ITIN, but this ITIN is tax ID number loans where you have folks that are coming that are not citizens that are coming across into our country legally, illegally, whatever the case may be. But they're employed and they work hard and they need a house, they need a mortgage. There's a lot of banks out there that will lend money to these folks, and they're called ITIN loans. And the reason that they're so popular is because they are high interest rate loans. So everyone wants those higher yielding loans. And to be honest, our experience in the loan business is that they're pretty good payback loans. Like we see very little defaults with ITINs if they're underwritten correctly. So we have a joke. It's like, especially when we're in Texas, and this is just, it's the Americans you got to watch out for. They're the ones that, that will get cute on not paying the bills. But on all seriousness, the ITIN is it's a big appetite out there for that. So that's what we've been seeing on the institutional side. On the seller finance side, it's the craziest mobile home parks, Bitcoin mining facilities. I mean, we have this on our pipeline right now. We have an Alabama Bitcoin mining facility that was sold on a seller finance note that no one wants to touch. I mean, it is a 3% interest rate, but no one wants to touch it because they're so afraid of that word, Bitcoin or crypto. But there's so many esoteric types of properties. And then you have your regular, single families, but we're seeing a ton of that right now. And as a matter of fact, we are busier than ever on the seller finance side. So it's very, very interesting. Past 2 months, though, it's been tumbleweeds, and it's not because of we were not visible. It was a market in the seller finance space. It was a market slowdown. So it's just what we're seeing.
Kind of hard to predict those, isn't it?
It really is.
Yeah. How about where's the to get your top tier pricing, where's credit gotta be these days?
So it's funny, we're actually seeing top tier pricing on credit in the 640 range. You don't
Really?
need a 720 FICO to get top tier. What underwriting's more interested in, and this is not just us, not just our syndication and capital partners. They're more interested in if even making an aggressive offer, if the credit isn't good, but we have a ton of requests for borrower financials. So I've been doing this for 26, I've been in the mortgage business for 24 years roughly. And doing this since 2006. The only time we ever ask for financials on anyone is if we're buying a business loan secured by a small business. But this is the first time I've seen, specifically with commercial, that the seller finance space is starting to ask for things that a bank would ask for, which is a little bit, that's the big takeaway here, which is unusual. And even if it's a single family residence, if it's being Airbnb'd or if it's a rental, they're going to want financials on the borrower, or they're going to want rent rolls. We actually have one right now, not too far from you, in South Lake Tahoe, where we're arm wrestling with a landlord there who is arm wrestling with his borrower to get financials. And she's I mean, it's tough. It's tough. We have some very large balance deals that are on the verge of collapse because of this financials issue.
Yeah, because after the fact, I mean, if you've done your homework and you had you had your underwriter in the beginning,
Hmm.
that's one thing, but that's
It
like a
is.
relatively new thing. But everyone before that, you really don't have a lot of leverage unless it's already in your note document somewhere, in the contract somewhere. The borrower doesn't really have to comply, so that's a problem
It
then.
is a problem, and we are trying to entice. I have funny. I mean, we have one in Grass Valley, California, right now, currently, and it's a beautiful property, and it's we were like, look, we need the financials on this, and we're not buying this one. We're actually flipping this to an institution, and they're like, we're not going to. The reason why they want financials is because the seller sold the property to the borrower. The seller used, now this is a good lesson here for everyone who's using corporations to create mortgage loans. So his LLC sold the property and collects, his LLC is being paid as the lender from a borrower who's an individual. So according to Dodd-Frank compliance, that's, you got to have an RMLO. Now technically, if you do more than three a year, this institution that we're flipping it to is like, I don't care if we get audited. We want to make sure. I don't care if I don't want to go through the minutia. Did he do three? Did he do two? And I just want the item so I can get the auditor off my back. I don't want to have to double click on this after the fact, 3 years from now when we're getting audited, or 6 months from now, have to go back to the seller and create this problem. I want the financials now. I get it. I understand why. So I explained that to the seller, and luckily, very luckily, we have a very understanding seller who is apparently told his borrower, "Hey, we're selling this note. I did this there. I did this wrong. He's saying if we get audited, I can get in trouble. Can you please provide me with the latest W-2 stub?" And she did, and or she's going to. So last we heard. So, but that's a reason. Like, so if you're manufacturing mortgage loans, seller finance mortgage loans, and you're using an LLC to do so, and your borrower's not an LLC, and you try to sell that loan now or later, there's a possibility that they're going to ask you for financial. So if you're ever manufacturing a loan, creating a loan, originating a loan, I would highly recommend that you, at the very least, have them do a credit karma report to give it to you so you can at least see their credit report before, as part of the process of creating the loan. And then in addition to that, ask them for their financials, tax return from the previous year. And, you're not going to scrutinize it, but you definitely want to make sure that you have that. And if there's any red flag, and this is only if you plan to sell it. If you plan to keep it, fine, great.
Right.
You're probably off the radar, but it's still good practice to get into. And as we progress further into the future, this is going to become way more prevalent, according to the Consumer Financial Protection Bureau, which just actually, and you guys and gals may not know, they just put out, I think, a report 2 weeks ago, 3 weeks ago, that they're going to start cracking down on contract for deeds as well. So we believe that's the first step to expanding their policing of the seller finance space. Not there's no, not don't run for the hills. Just be aware that it's coming on their radar, and there's a protocol. And the protocol is, if you're operating as a corporation and you're dealing with an individual, get their financials or hire an RMLO that will pay the extra 300, 400 bucks, protect yourself, get the file, and it's just like lender's insurance. Call it an insurance policy.
Yeah, that's a great comment. It's just like this steady creep, just one thing after another, I mean,
It is.
David Kurtzman, who's on here, was telling, oh, there you are, Dave, was telling us.
Hey, David, how are you?
Yeah. Tell us, hey, Dave, just come on and just describe what's happening in Southlake, like with real property rights, with the thing on the ballot that you.
Right. Okay. There's a ballot measure. We've got a progressive city council person, for lack of a better term, tried to get a vacancy tax passed by the city council, and they turned him down 4-1. So they used the spaghetti theory in gaining signatures, and they just went around to people saying, would you like to support affordable housing? Sure, sign here. Jeez. And they got enough signatures that to get it on the ballot. They needed 10% of the registered voters. They turned in so many signatures, they had a 44% signature failure rate.
Wow.
And still got it on the ballot. So that tells you the technique they used. They were totally dishonest in what they represented. However, it's on the ballot for this November, which basically says is if your property is vacant 183 days a year, there's a $3,000 vacancy tax the first year and $6,000 after that.
What do they expect to gain from? I mean, it's like all you're going to do is just push people
let's
away.
Put it this way: they're claiming it will generate $30 million. Realistically, it will probably maybe generate $1.
I mean, if
it's going to be $1 million, it's going to be $1 million, $1.5 million to administer it for openers. And then give you an idea that we have a 280 unit low income housing project that's just being finished up. $850,000 per unit construction cost.
$850,000 per unit. That's insane.
Yeah. And so, even if this thing generated any money, it wouldn't accomplish much.
Wow.
So, I mean, the National Association of Realtors and the local board and all the different entities have already spent, I think, close to $900,000 against this, because I know they're talking about it in Frisco, Colorado. All the ski towns are talking about it. And the reality is they underpay the employees, and the employees can't find a place to live. So let's figure out a screwy way to try to create housing.
Wow. That's
unfortunate. That's, as you say, potentially another thing coming down the road. Hopefully it's defeated.
Yeah, to me, it's
Oh,
just another example of that slow creep of collectivism that's
yeah.
just,
Collectivism.
Although
That's
this was
that's
not
it.
government generated, and
well,
the
It,
government
it, it sure sounds like it. I mean, and not not in name, not in feature, but in the tactic and it feels a lot like that.
yeah,
I would say.
I mean, it is a private citizen initiative, which was
Sure.
totally opposed by the government. However, if it passes, now the city would be obligated to enforce it
Ah, I see what you're saying.
and
So I
defend it.
gotcha.
It becomes a government issue if it passes.
Gotcha. So
Yeah,
the right, the activism behind it. I
right,
understand.
right. So,
Yeah.
it's some activists that managed to get it on the ballot.
Yeah.
And
No, it's a
here's the irony. Unfortunately, they just need a simple majority to pass it. If
wow.
the city council by choice had put it on the ballot,
Hmm.
would have required 55% to pass. But since it was a citizen initiative, it only requires 50%. All
Wow.
the little
Yeah.
nuances of laws in every state.
Sure.
So I'll report on November 6th.
Yeah, no kidding. I'm curious, and that's very interesting. I'm curious to know, I mean that, and I don't want to provide some value here to everyone listening on what you guys and gals want to hear, but I just to kind of finish this thought, if they get charged so it's $3,000 a year if it's empty 6 months or more. Do I have that right, or is it 3,000 a
Correct.
month?
Well, it's a direct attack on vacation homes.
So that's what I'm saying. So you have the Airbnb, and then it also sounds like it's a direct attack on people with second homes too, right? So
Yeah,
people,
yeah.
people that are buying coming out of the Bay Area or LA, that the whole
Correct.
pushing the
Yeah,
prop
vacation homes, vacation rentals,
but
everything in that category.
that's what Tahoe. I mean, it's crazy.
And the irony is everybody's complaining we have over tourism. So if it passes, they're saying you've got to rent your place more.
Wow. Wow.
In other words, it's not well thought out, and that's why so much is being spent to try to defeat it.
Right. Yeah,
yeah,
yeah.
it's that centralized planning always kind of
Mhm.
just goes awry. You got to let the market just filter
Yeah,
itself out.
that's right.
Yeah, Brenda, they want us to think it's not their idea. Yeah,
That's
it's
right.
just a little too reminiscent of things like I don't know.
The past 10 years? Everything? All right, we're
But
not gonna.
hey, Abby, I just wanted to clear up the so in general, we talk or we teach people and we're always talking about it. You hear it everywhere now. Everyone's pretty much on board with anytime you're going to do solar financing. It doesn't matter if you just done one or even if so no matter what, if you're a corporation, you're an LLC, you're a private party or a trust, whatever, just do the thing. I mean, usually the buyer pays for the underwriting, right? Their own file
Mhm.
to be underwritten. That's just part of
That's
their
correct. That's part
closing
of the.
cost.
That's
But
right.
but the point you were making is it's not just the number of them, but just the fact if you have an entity that's the beneficiary
So
and they're not a licensed oh gosh, debt buyer or whatever.
RMLO, residential loan
Yeah,
mortgage
so
loan
even if they
originator.
only did one and they're a corporation, you're saying that's also, and I hadn't actually put that together because I'm just carte blanche saying, hey, it doesn't matter, just get it done. It's an
Yeah.
important piece of it, but is that nationwide? Is that a federal
So
thing?
yes, so Dodd-Frank will say Dodd-Frank, it's the Dodd-Frank Wall Street Reform Act, right? The seller finance
Well,
section.
right,
Yeah. So that's going to say if you're creating more than three a year,
right,
you need to be a licensed residential mortgage loan originator, or you need to hire a residential mortgage loan originator. So $300, $400, easy peasy, right? It's not the end of the world. And just so we're clear, if an MLO comes in and starts doing this, it's not they're not going to go to you and say, "Oh, this guy has terrible credit." You, as the lender, set the criteria. So if you say, "Hey, I know these people have terrible credit. I'm just making sure that they can afford it. They can afford
right.
they So it doesn't matter if they have bad credit. You just what the government or the quasi-government agencies want is they want to make sure you're not shoving someone into a loan that they can't afford. That's what they want. And rightfully, look, I get, I understand the intention there, and there's some good that they're trying to achieve, but that's the goal, right? They want to make sure they're not being shoved. So that's one aspect. The other aspect is if you're transacting as an entity and you're making loans to individuals, in their eyes, that could look predatory, right?
Yeah.
You're the big bad company making loans to
Right.
Mr. and Mrs. Smith down the street.
Yeah, exactly. Well, gosh, I don't know that many investors do consumer loans anymore unless they're
That
a banking institution. It's just too dicey. I don't know. I wouldn't recommend anyone do a consumer loan.
Right. And the only way you do a consumer loan is if you are an RMLO, and it depends where, right? So if you're in the state of
Right.
California, California is a lot of things, but it still is an attractive prospect for residential consumer loans, believe it or not. I mean, otherwise it would be, and I hope no one's from these areas, but it would be Chicago. Nothing against Chicago, but there's been a massive capital flee out of Cook County, Illinois, because of the jurisdictional restrictions that were imposed on this county during COVID that were exacerbated previous to COVID. And their foot has been on the gas pedal and it's never been taken off. They haven't corrected course, nothing. And that's why there's a massive capital flee out of there, meaning corporations, investments, I don't know, Dawn, I know you remember this back in the 2008, 2009 market crash. Detroit got nailed. I mean, there was no note buying company that was buying notes in the city of Detroit, right? I mean, do you remember this for
No,
years?
I just remember it being devastated.
Demolished,
Yeah.
devastated.
Yeah.
Detroit is now in the middle of a renaissance, by the way. I don't know if anyone is paying attention or knows that, but if you go down to downtown Detroit right now, it is in the middle of a renaissance. And I say kudos to them, because if any city deserves it, it's Detroit for sure. And that's because they restructured. They did have a corporation. It's like that, literally. I don't know if you guys ever saw that movie RoboCop, but it was like RoboCop come alive. The city was such in bad shape that they had to hire a outside literal corporation to come in and start running the city. The corporation came in, got the city back on its feet, and now it's in the middle of a renaissance. I'm oversimplifying it. It still has issues, obviously, like any American city, but you go down to downtown Detroit now, you're going to see food trucks and art galleries and restaurants, and it's crazy and good for them. And Chicago should take a lesson from that in the sense of their governance. So you just want to make sure that even if you're getting into consumer loans, back to the point, is that you are bringing in an RMLO, and you're also making sure what happens if I make this consumer loan in this state, in this county. Like in California, it's about 120 days to go through a foreclosure process. But if it's a consumer loan, you got to go through this very organized situation, this process where the borrower has a chance to make good on the deal, and the state steps in and says, well, this is the roof over there, and they're in their family's heads. So let's see if they can catch up. So it's not as quick as it would be for, like, instead of 4 or 5 months, it may be 7 or 8 months, because they have 30 or 40 days to get their act together. And if they don't, you can continue with the foreclosure or the restructuring. Not so bad. It's not like New York or, the 5 boroughs, which it could take literally, and I'm not exaggerating. Right now, we are up to, it will say on a website, like on our website, we have all the foreclosure laws on every state. And I think it's like 600, it's actually, you're not going to like this number, 666 days to go through a
Oh,
process.
well,
It,
it's in the code. Everything is in the code,
it's
Abby.
in and that's what they just say. It's more like 800 days. So understand that that's almost 3 years to go through a foreclosure process. And you're just waiting for a judge most of the time. And while you're doing that, they or other people can live in that property for free. So that's a place where I wouldn't do a consumer loan.
Yeah, that's crazy. You know, you're talking about well, that's interesting. There's a private investor that has he and his wife have been with me for many years in California. She died and then he's been taking over. I don't think he was driving the investments as much as she was, but then of course since she passed, he's been taking over, and I think he got really googly eyed over, he goes, well, we were only getting, we were only getting 7 and 8% before. Now I can see that I can loan money out at 10, 11, 12%. And he just, I brought him a couple things and he says, no, I can really do a lot better than that now. And I go, hey, good for you. Well, anyway, I just found out just recently he's got now 5, 6, 7, somewhere, like he's got a whole handful of problems of all just in the last few months of investor loans that have gone bad.
Wow.
So now before they had zero, problems,
Problems.
defaults, and now his whole life is going to be taken up with
Wow.
doing the foreclosure. I said, hey, you can get out of some of them. And if there's enough equity, the haircut won't be that bad. But he's like, no, I got time. So he's going to travel everywhere all up and down California and foreclose on them and personally fix them up and turn them around. But it's like, that's
Yeah.
really different now, where in
Yeah.
some sections, it's just what I'm hearing anecdotally from, my little world of private mom and pop people. Things are changing a bit. Even another guy that, gosh, I was so, yeah, it seems so young back in those days, but in the very early days of my Note Queen development, I was speaking around at clubs, and it was down in Long Beach. Anyway, this guy, he's so cute because he says, oh, you're the one that introduced me to the concept of arbitrage, how, you
Hmm.
can make that spread. So then he's done gangbusters, and he showed me his portfolio recently, and it's $30+ million worth of loans, mostly investor loans, and properties, turnkey property, rental properties.
Yes.
A lot,
Hmm.
a lot big. And all of a sudden he's got like, I don't know, just maybe a dozen that are kind of going bad. And he's going, well, maybe I want to sell these. But then he didn't realize that you'd have to take a discount. So he says, oh, never mind. But,
Yeah.
one of the, greatest guys and honest all day long, he'll break his back so his investors never need money. But what if the market, drops by 30%? All his loans are underwater.
Yeah.
Right. And so investors can walk away. I mean, a lot of these investors, they don't even have a dime in it. They're borrowing. People are so hungry for yield. They're
Yeah.
they're they're lending on seconds plus the closing costs plus the rehab costs. What's the investor going to do when like they're going to walk
Mm.
away? A
You're
homeowner,
walk
maybe
away.
not so much, right?
Yeah. Yeah.
And so it's just I don't know. You have any comments? Anyone else want to comment on that? What you see out there? Because I mean, I had a conversation today I was going to share too with someone I thought was sort of enlightening, but go ahead. I mean, what default rates are you seeing that, or I mean,
So just so
just
as
to me, in my world, what, the little birds that come from various things are telling me different things of like, there's a sea change
there is a sea
starting
change.
to show up. So,
There is there's a
but
sea
you
change.
said there's this massive appetite still, and they're just, your I-10 loans on all these different things. People are still going like it's the gold rush
Well,
in a lot of areas, huh?
yeah, it depends where. It's all about jurisdiction. That's become so back in the 2010s when we were kind of rocking and rolling, you and I, Dawn, it was anywhere, right? And for the most part, as long as it wasn't, between Reno and Las Vegas, anywhere but between Reno and Las Vegas, you were good to go, right? Nowadays, it's not. I mean, well, because there's nothing between, Area 51, right? So Groom
That's
Lake,
not nothing.
Right, sure. Well, that's not real estate that we're allowed to participate in anyway. So
Correct.
I said, you're dissing on Tonopah,
is that, I don't know.
Nevada,
So is that
midway
where you're at?
between. No,
I
it's
am.
midway between Vegas.
No, yeah, Tonopah's where where we stay when we're driving
Right,
from
where you're
Reno
driving
down to
between.
Las Vegas because it's right in the middle.
Gotcha.
Yeah.
I've never had the pleasure of
Well, and I always think when I see that
Doesn't
sign,
miss much.
okay, this is only for people who are local, but you know the song Panama,
Yeah.
it's the rock and roll. I can't remember who sings
Like
it, but
Van Halen or something?
Van Halen, something like that. Yeah.
It's Van Halen. Yeah, yeah, okay.
Yeah.
Yeah, just looked it up.
Yeah, Clown Motel, Joanna. I always think when I see Tonopah, I'm always like, Tonopah. Like it's just in my head. Okay, this is really high value entertainment. I realize. I'm sorry. We will get back to the regularly scheduled program.
It's all about jurisdiction, right? So Texas has been every single person wants Texas, every single person wants Florida, every single person wants Tennessee, every single person wants the Carolinas. We're seeing a lot of momentum. I've never received as many notes as I have in the past 3 years in Nebraska, Wyoming, Montana, Idaho. These are all of the beneficiaries of COVID for the most part. And California, for sure. I mean, say what you will. One of those beneficiaries that we're not seeing a ton of is like Arizona. We're not seeing a ton there. We're not seeing a ton in New Mexico, even though you would think that that would be. And again, that's because of the jurisdictional restrictions imposed by local and state governments. So that's where it all boils down to with where you're saying this is still rolling. But what we've seen.
Are you actually implying it's at least loosely a red blue or policy sort of?
It's a policy. It's not red blue because there's certain areas like, again, California, very blue, right? The bluest, and this is not political, but the bluest parts are suffering. But like Inland Empire, Riverside County is on fire. Or excuse me, San Bernardino County is on fire. Joshua Tree, Riverside, on fire, still very blue.
California is red, right?
East of the right. So coasting, right. So the red part of California is on fire. If that's what you anything west of the I-5, east of the I-5. But no, in all seriousness, California is still a major player in this market. Washington State, a major player in this market. Parts of Oregon, major players. So it's not necessarily just that. And then you have your local investors that still want, that are hounding me for Brooklyn non-performing. Whether they get it or not is a different story. But, so it's about appetite, but on a national, it's because there's different levels, but on a national scale, it is about jurisdiction. It's, whether it's red or blue, it's policy. It's what policy has performed the best over the course of the past 4 years. That's where that is the natural way of things in the freer market. I won't say the free market because it's definitely not free market, but in that direction.
Right. Well, also, then you've got the deed of trust versus judicial foreclosure process. So that's huge as well. So there, it's just the layers of complexity have just continued to grow in the space. But at its fundamental level, one mom and pop to one mom and pop, still pretty, you do the safe things, get the underwriting, fill out your file. Have licensed servicers and it's really a beautiful thing. But in terms of just note investing, there's just a lot more moving pieces to think about. So that is fantastic.
I'd like to add one thing, if you don't mind, just to that list. So I also, not only do you want licensed servicers, if you want to maintain the value of the note, I would recommend getting licensed servicers that report the borrower's credit habits to the bureaus. Because that way, if you ever have to sell that note, that mortgage, if you're giving that borrower the ability to make payments and they pay great and all that, let them report to TransUnion, Experian, and Equifax. That way, when you bring it to a company like ours or one of our competitors, they're going to say, hey, this guy or gal has great credit and we're going to pay you 8, 10, 12% more than you would have gotten if you didn't.
Yeah, good point. And that's part of why I like Madison. And ever since you and I, boarded our little portfolio with them, I've been doing all my new boards with them. And
Yeah.
so they're almost national. I think there's a handful of states they're not quite licensed in. But
No, well, New York is one that they were
well,
licensed and they pulled out of, I think.
yeah, gosh. And
Yeah.
then you know what? These companies that are nationally licensed, I had no idea how much it cost to keep up licensing. When I was visiting with Madison Management is now based in Reno,
Yeah.
and I was
Yeah.
talking with them last night. But they're a nice small company, husband and wife owned, very high integrity, very smart people. It costs them just shy of $300,000 a year just to hang the shingle,
Oh
right?
my
In
God.
in 42 states, I want to say they're in. And so just for context of why do they have to charge so much for servicing? You have no idea what
Wow.
they have to pay to keep everything up, to
Right. That's
like
crazy.
it's just a really big number. But also, who else reports? I know in
August REI,
August REI in Texas. I think
just
they're only
Texas,
Texas.
only Texas.
I don't know if there's others that do. Does
There
FCA
is Security National
Security National
does.
does? I've never
Yeah,
worked with them. I've never worked with them.
either have I. I've heard good things and I've heard not such good things. I know people that work with them consistently. We like Madison.
Yeah, and also because they came into the business, I'm just giving them a little plug since I enjoyed having lunch with them recently.
Yeah,
But
yeah,
is they came into it not just sort of accidentally because they need to service their own. They started buying non-performing notes. Some people start down the rabbit hole first, and so
hmm
they started with non-performing seconds, I think. And so they were just like, hey, we need to work out our own things. And then their friends would ask them, well, if you're doing it, can you do it for us too? And so one thing led to another, and they've just built it up from a little desk and a chair. They were both IT executives, highly paid people, professional people. So anyway, I just give them a plug. So they also do some MLO in a few states as well as
sure.
hey, okay, back to your Bitcoin mining note. Okay, let's get back to that because the last time you and I were on, we got all rabbit holey and weird on people,
Yeah, we
just
did.
talking about stuff. So
Yeah, yeah, yeah.
we were saying back in the day, 4 years ago, we really think this Bitcoin thing, or and I don't know if I was always telling people to diversify. Like real estate notes is great, but like you need to have more buckets, in my opinion. So the crypto thing, Bitcoin was at 10,000 when we were flapping our jaw, and now it's
Actually, it was 3,800 on March 8th. I hung up with you, and so I didn't want to say that I'm going to go ahead. I hung up with that call, and either the day before or the day after, I went on a buying spree because COVID
I
dropped it to
remember that.
3,800.
Yeah, I thought it was even lower, and I'm so mad I didn't pick up some more at that time, you
Yeah,
know.
yeah,
But anyway, so now we're going sideways for a bit in the low, hovering under
60s.
60,000, and also gold and silver. I mean, back
Yes.
in those days, I think gold was at 1800-ish or something. Silver was
So
21 or
silver is on the track. So Samsung just announced that they created a single state, I don't know if I'm saying it, solid state battery for electric vehicles that will allow a 600-mile range charge, blows Tesla out of the water. They need 76 ounces of silver to make every electric battery needs a certain amount of ounces to make 32 or something. I don't know the details. I don't want to misspeak, but I will tell you that I think there's 27 metric tons of silver mined every year. Just if you look at the math, and I'm parroting what I read, but on electric vehicles, as is, if the electric vehicle market hasn't grown anything and it hasn't grown at all, and they implement these new batteries, it would take up 16 metric tons of the 27 metric tons. And that's just for battery. You know, my point is that silver very well may go into a very steep bull run here in the next couple months. They just announced this like, I don't
Yeah,
know, days, weeks
and
ago.
yeah, I mean, I've been pounding this diversification and preparation. I mean, have some food, it'll double in price by, just give it a little time. Have a little preparation, physical things that you need, some gold and silver, some crypto, some different things. So, yeah, I so basically, if someone comes and says, "Look, I got $1 million," and let's just presume they already own their house and maybe they got a rental, maybe a couple notes, private loans or something like that. They got $1 million. Like if you had someone just gave you $1 million, how would you break it up? Just roughly, like into diversifying in different asset classes, just so that, hey, if this goes down, this will stay up, but if this goes down, this will be up,
What are you talking about?
Yeah.
Yeah, I just
So
want to know, like, hey, because also, okay, gold and silver at your house, but there's a risk. So then I have some that's with a custodian, in the big vaults.
yeah, that's
So
gonna
I've got some that's in qualified funds, some that's, in my hand.
yeah, I gotta
Things
tell
like,
you
what I mean? Do you have
that
any?
so yeah, I do. I have a lot of thought. If this is individual specific, right? So for me personally, I'm always a fan of mobile wealth. That is my thing. I physical bricks, owning real estate, physical gold, that's all well and good. We own our real estate, we have our equity. But if I try to look at as much policy coming down the road in the future, and that policy indicates that, okay, so on $1 million, diversification is very key. I personally would diversify, at least 30 to 40% of it in mobile wealth. That could be in, when I say mobile wealth, I mean wealth that you could, and I'm not saying I would do this, but if you had to, or if you wanted to for vacation, you want to pick up and move somewhere else, you can be in the note business and live in Thailand, right? You may not be trading, but you can be buying and managing notes from Thailand, from, Russia, from El Salvador, wherever you want, Philadelphia, doesn't matter. All you need to worry about is the payments on time, are the taxes paid, and is the insurance on
Yeah.
there. So you can do that all through like Madison. Crypto. I say crypto. The only thing I look at nowadays is Bitcoin, right? So I own others, but Bitcoin is Bitcoin, and then there's crypto, right? So, but let's just call it digital assets. Digital assets you can custody yourself, and that's very mobile. I would say at least 30 to 40%. And then the rest, you decide if you want to put that in real estate, if you want to put that in, bullion or precious metals, food stores, Rolexes, whatever you want to do. And I personally see that 40-60 actually changing and being very fluid over time, where the digital asset and the mobile wealth may be a 60% allocation, where the physical is only a 40%. That's me personally.
Yeah.
I don't have a family of 10. If I had a family of 10 and a bigger group of folks to kind of look over, I would maybe allocate that differently.
Yeah, I think it's important. You've been following just the steady implementation and adoption of the blockchain technology. I mean, it's outrageous
Everything.
how much it's every day there's something.
Yeah.
But
Everything.
you got the talking head saying one thing, just like they always did, but on the backside, they're saying, it's a pet rock. And in the back, they're buying it up. You've got pension funds buying into Bitcoin now. You got, state funds, sovereign countries,
Yes.
all sorts of things
Yep.
everyone wants a piece of it, right? It's the new financial system in a lot of ways. Looks like the CBDC, it's going to be so sneaky that people won't even know. It'll be so easy, like Venmo and everything like that. People won't even know that we're using digital currency.
That's a good point you bring up. So just so everyone listening that is interested or thinking about getting into some sort of digital asset, I highly, if you're going to look at it, I highly recommend Bitcoin, just because that is the only asset that the government looks as a commodity. It's the only asset that passes the Howey test, which is a test that has been around since the 1920s that determines if it's a security or a commodity. So Bitcoin, in my opinion, is the only truth. That being said, you can buy pieces of Bitcoin. And if you do that, right, so one Bitcoin can be divided 100 million ways. So
Satoshis. Yeah.
Satoshis, 100 million units in one Bitcoin. So you don't have to buy one Bitcoin. You can buy 100,000 Satoshis that, and dollar cost average in. The point being, you want to make sure if you are going to purchase any kind of digital asset, that you are able to take that digital asset off of the exchange that you buy it and put it in your own hardware wallet. That is extremely important. If you buy it on PayPal, if you buy it on Cash App, they'll let you buy a Bitcoin on PayPal. It will be very easy to buy a Bitcoin on PayPal. But if you try to take your Bitcoin off of PayPal, they'll say, no, 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 we'll give you cash. You can take the cash out of PayPal, but we keep the Bitcoin. So if you have $20,000 in Bitcoin and you say, I want to get my Bitcoin, they'll go, yep, here you go. Here's your $20,000 in United States currency. Right. See you later. So you don't get to take the Bitcoin with you the same way you don't get to, like if you buy a Tesla stock or a Microsoft stock, it lives on Fidelity. It lives on, Charles Schwab. You don't get a piece of paper saying I own Tesla. That's not, you can't even custody your own stocks. You know what I mean? So that's why gold and silver and Bitcoin are very important, and where you buy it is very important.
Right. I mean, they pretty much buttoned up the on-ramps. You can't really get past having a KYC, know your customer.
Actually, you can. So I'm going to put something.
Well, I guess we'll talk about that. And that might be going down, but it's pretty tough to avoid for most people, Coinbase or Uphold or some of these exchanges. But if you, okay, I'm going to click that just to have.
Bisq.network, excuse me, Bisq.network. It's not a network. It's not a website ran by humans. It's a software protocol that allows you to buy and trade Bitcoin.
So this is the DeFi.
Exactly. We don't want to get too
okay.
far down
I hadn't heard of that. I hadn't heard of that.
But anyway, literally brand new.
like what that. See, hey, this is the good stuff. The weird stuff here at the end. But in terms of being mobile, if you memorize, you got your little hard. It just looks like it just looks like a little drive or a little box, something like this. A little hard wallet. And there's a seed phrase. There's like 12 to 24 words. And if you memorize those, you could literally walk over, like if something weird happened, you could literally walk naked across international borders and reclaim your money. Right. And have access to it. So I don't know. I just think it's an important diversification. And I think we did pretty well calling it 4 years ago. Yeah, what do you think?
Sure. I think
I think it aged well, our video.
I saw it online, so I know you posted it online. I watched it not too long ago, and that wasn't the only thing that aged well, just FYI. I mean, very much so. That was with Mike, right? So Mike that bought the seconds. I forget his last name.
Oh, Rasica.
Yeah, Mike Rasica.
Yeah.
Yeah, so it's been a minute since I spoke to him, but that whole video aged well. And the reason it aged well is because there was no real secret there. I mean, this is kind of what they've been talking about. I mean, you can easily see. So the reason that we knew what it was and why that aged so well is the CARES Act, right? So the CARES Act was they had that ready to go. So you could go to congress.gov, whatever, and you found the CARES Act, which was what created the stimulus and all that good stuff. And we were talking about it. The very first chapter of the first draft of the CARES Act was digital dollar. In a freaking piece of legislation for a virus, the first thing was digital dollar. So it was very clear that there was a money aspect to this whole thing. And the money aspect obviously had to revolve around, and they immediately, that was the first draft. So they got rid of that very quickly. But a lot of people saw that initially and reported on it. So it was very easy to understand that it was more or less, I called it at the time, a hostile takeover of the money system. And
Absolutely.
that's what it was. I mean, unfortunately, and it wasn't hostile in the sense of violent. It wasn't a violent takeover. It was just like a hostile takeover of a corporation.
Well, yeah, it's just the way to throw us into the death throttle of our fiat currency system so that, problem, reaction, solution, create the problem, you come in with a solution. Oh, by the way, it's less freedom and more rules. Sorry.
Yeah,
And,
sure.
so it's just interesting to watch. And just, you don't want to be a freak and be scared all the time. It's not just be prepared for the worst. Like, make it so that you have wealth and things that will actually, what if you couldn't go? I always am saying this all the time. If you can't go to the store or order anything online for a whole month,
You're in
can you
trouble.
take care of your family? Okay. Just make sure that at least for 1 month, you can't go to the store. You have ways for food, water for purification, sanitation, medicines, heat, backup light, just a few things. I think that's one of the most important investments people can make. And when people, come and say, well, I have $5,000 to my name, can I get started in notes? And I'm going, that's not the first thing I would do with $5,000.
No,
Because some of these other things that are, I mean, I can't believe that we're still having this extended buy box and accumulation zone for crypto, but a little money right now could go a long way.
agreed. I just want to also say I am putting into the chat here links for foreclosure laws in every state. So
Oh, fantastic.
if anyone needs to refer to what foreclosure laws look like in states that you're thinking about investing in, you're not really sure. And there's many different options. We just put this free information on our site, and then I also included owner financing tips. It's basically just you know if you're creating an owner finance loan, what the owner finance lender should know, and that's a very important piece of the puzzle. It's lengthy, it's thick, it's a little dense, but it does have little chapters, and you can kind of go through that.
Oh, fantastic. It has just been really what a pleasure to have you on. Thank you so much for
Thank
giving
you,
me
thank
your
you.
evening. You've just been always one of my favorite people since you bounced into my world
How about that?
that first property and paper summit in South Lake Tahoe. We just fell in love with you and Molly's.
Yeah. Oh, thank you. Same. I miss it. I miss it. I miss it. But
But
yeah, so
now look how far away you are. Before
I
you were
know.
4 hours away. Now you're
So
like,
close. I know it's worlds away, worlds and worlds away. Well, we had to go somewhere where it was, part of the reason was the, obviously everything that was going on in the world, but really a lot of the reason, and truth be told, we were not heavy in real estate in California because we couldn't participate in that market freely. It was extremely difficult to participate, without being, like
right.
this. So we were looking at Tennessee, we were looking at Texas, we were looking at Florida we were like, okay, if we're going to go put roots down, it's just Florida for us was a wealth generation play. It's not because I hate mosquitoes. I hate humidity. You know what I mean? It turns out Florida is actually it's a very beautiful place. And I learned to love it over the past 3 years. But if you would have told me this, back in 2019, I would have laughed in your face. But the one thing that Florida is good for, and Texas and Tennessee and South Carolina, by the way, Florida and South Carolina, judicial foreclosure states, right? So that doesn't always, hold true, but you can transact in real estate. The real estate is way more affordable. So everything is just as expensive, except for the state tax rate, but they still get you on the insurance, the homeowner's insurance. It's crazy here. But you can buy and transact in real estate, and the fuel prices way cheaper. So that was a big thing. And once we finished this build that we have, so that 2 properties in 3 years. and then we're off. We're going to go somewhere else.
Well, thanks again. And thank you if you're still hanging with us after this. Appreciate you. If you want to
Yes.
participate live, don't forget to go over to propertyandpaper.com. That's where you can always register for the next upcoming Zoom. And I appreciate you. Go out there and create financial solutions, just one mom and pop to another. We'll catch you next time. Thanks, everyone.